It does sound like another big deal with what feels like it's got a big window on visibility for CoreWeave. Lay it out for us.
Yeah, CoreWeave has 33 data centers, mostly in the United States, some in Europe, and they are all humming and they're all being used up. And honestly, that answer in the context of the Meta news today was a bit of a cop-out because they are supply constrained. In other words, they have all these deals on paper that extend over a long period of time. In Meta's case, the deal that we broke the story on today goes through to 2031 with an option to extend to 2032. It's not yet real. There isn't a data center among those 33 that's going to, from today, run Meta inference or training workloads. But the thing to understand is that CoreWeave's magnificent run since its IPO, which Tim alluded to, if there was one piece of downward pressure on the stock that maybe was holding it back a bit, it was this idea that it only had one customer, which was Microsoft, accounting for 70% of revenues. And the simple answer to the move in the shares today is the market saying, good, we like to see diversity in your customer base, even if it'll be a few years that this stuff comes online.
Why would a customer go with CoreWeave rather than another provider?
Because compute capacity, whether you're talking about literally the building of a data center or changes in generations of chip, takes many years and billions of dollars to come to fruition. The way that Michael explains it is they're not going to do a deal where they don't have some idea of which data center or even some idea of like the energy supply for it, right? But the reality is this is probably 2 years away from Meta running these workloads. And at the same time, Meta is also trying to build its own data centers.
Right.
It's just an acknowledgement that they will need more than anyone can do at any given time. And the thing you need to understand about CoreWeave that puts this all into one place is that largely what Microsoft does with CoreWeave is give it the workloads it can't handle itself. Microsoft has many of its own data centers. There's just too much.
It's kind of an outsourcing, or it is an outsourcing.
Exactly so.
One of the things I want to ask you is this kind of starting to feel a little bit silly in terms of the spend, the build out. It's got this also incestuous feel of the companies working together, supplying things to one another, benefiting by the partnerships. It's just starting to feel a little bit close. And some much smarter than me are suggesting that this doesn't quite feel right. Will the revenues and financial payoff be there after the spend?
So this is what Wall Street calls circular financing.
Correct.
And you know, the greatest example of that is OpenAI and NVIDIA, but it could extend to CoreWeave.
Well, explain the OpenAI and NVIDIA, because if OpenAI gets money from NVIDIA to then go and buy from NVIDIA?
Yes.
OpenAI received a $100 billion investment from NVIDIA.
Over a number of years.
Equity investment over a number of years, a decade. So it's actually defined by gigawatts of data center capacity. For each 1 gigawatt, it gets $10 billion in the form of, you know, actually, we don't really know. That's the thing. We don't even know, like, is NVIDIA just going to write a $10 billion check, or is it going to give it chips in lieu of cash? So anyway, the argument is that OpenAI just takes that capital in whatever form it comes to then buy $10 billion worth of NVIDIA chips.
Right.
So the critics and the bears would say...
Shell game? Oh, no. I'm not going to say that.
Carol.
As I said, some smarter than me have questioned this, and I'm just trying to be smart.
You know, like on X, people have used the phrase Ponzi scheme. So, like, I understand that. At
the same time, Tim and I are playing around with ChatGPT.
Don't bring me into this.
Using these tools and are kind of blown away.
The bear case is that the big picture forecasts that the market or industry for AI accelerators or GPUs, before you take into account electricity supply, concrete, labor to build data centers, is $4 trillion. That number's being artificially inflated by the circular financing mechanism. The counter argument to that is, well, there are plenty of software companies making a ton of money, higher margin revenue because of the investments they made in the last 2 or 3 years.
We see that in the earnings cycle.
Yeah, start looking at debt, because a lot of this is underpinned by debt. And that's a little bit worrying to some in the market. Others are completely sanguine.
These neocloud companies, right? There's a lot of debt involved.
Yes, correct. And also, you know, like collateralized loan offerings, they need issuance. M&A needs issuance, but I would start tracking it on your fingers, or if you're lucky, use your Bloomberg terminal.
I was going to say you might have to start using your toes, because it's getting so big at this point too. The flip side of that, though, Ed, is that there are those out there who argue that the productivity increases that we're going to see from these investments and the innovation that we're going to see from these investments, that's going to be huge.
Yeah, but like, oh God, I've missed you guys so much. Do you remember like 2 years ago, and I know it's hard to remember last week, I would talk about the money machine.
Yeah.
So like in productivity and stuff, just like customers that have spent some capital expenditure, or they've made some kind of licensing deal with OpenAI or whatever it is, what is their top line growth and bottom line growth been in the last 2 years? Is that evidence that they have had revenues in new areas? Some cases the answer is yes, some cases it's no. I don't, I'm trying to think of an example like Salesforce. Like, what does Salesforce even do? But like these are where you should look for evidence of that.